Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Dania Zafran bin Su. Okay, so what is capital structure? Capital structure is the combination of debt and equity that is used by a company or organization to fund its overall operations and growth. The capital structure can be a mixture of a company's long-term debt, short-term debt, common stock, and preferred stock. Company can raise funds in the capital market through debt. Debt also allows the company to retain ownership. Equity is more expensive than debt, and it also allows outside investors to take partial ownership of the company. Equity also represents a claim by the owner on the future earnings of the company. The company capital structure is typically expressed as a debt to equity ratio, which can be used to assess the riskiness of a company's borrowing practice. Company that is financed by debt more than equity has a more aggressive capital structure and hence possess a higher risk to investors. However, aggressive capital structure can also lead to higher growth rates.
Assalamualaikum, my name is Muhammad Al-Amin Bazuruddin. I will discuss about how to determining optimal capital structure. What is optimal capital structure? An optimal capital structure is the best mix of debt and equity financing that maximizes a company's market value while minimizing its cost of capital. So, how to determining the optimal capital structure? As it can be difficult to pinpoint the optimal capital structure, managers usually attempt to operate within a range of values. They also have to take into account the signals their financing decisions send to the market. Firstly, a company with a good prospect will try to raise capital using debt rather than equity to avoid dilution and sending any negative signal to the market. Announcements made about a company taking debt are typically seen as positive news, which is known as debt signaling. If a company raises too much capital during a given time period, the cost of debt, preferred stock, and common equity will begin to rise, and as this occurs, the marginal cost of capital will also rise. To gauge how risky a company is, potential equity investors look at the debt or equity ratio. They also compare the amount of leverage other businesses in the same industry are using on the assumption that these companies are operating with an optimal capital structure to see if the company is employing an unusual amount of debt within its capital structure. Another way to determine optimal debt to equity levels is to think like a bank. What is the optimal level of debt a bank is willing to lend? An analyst may also utilize other debt ratio to put the company into a credit profile using a bond rating. The default spread attached to the bond rating can then be used for the spread above the risk-free rate of a AAA rated company.
Assalamualaikum, my name is Muhammad Shazam bin Shamsuddin. And now, what is capital structure? Capital structure is a mixture of debt and equity used by a company to fund its operation and growth. Factors that will affect capital structure decision are the size of the company. Sometimes a smaller size company would have to resort to relying on the founder's money, but as they grow in size, they will be eligible for lengthier financing as more investors would come to invest in the company, as a bigger size company would be considered as less risky by the investors. And other than that, return on investment or ROI is also a factor that can affect capital structure. Return on investment helps in deciding the capital structure. A high ROI would mean that the investment is equal to or greater than the cost incurred. If the return on investment is much larger than the rate of interest, the company must use that as its capital structure. This is because if the rate on interest is larger, the company will have to suffer from a loss of profit. Besides that, another effect that would influence the decision is capital requirement. Capital requirements vary from a company to another. Every company does not necessarily need to have a large amount of capital. If a company needs a small amount of capital, they can choose whether equity or debt capital. However, if the capital amount needed is humongous, the company can combine equity and debt capital. To put it simply, the larger the amount needed, the more source of financing the company must acquire. Thank you.
Okay, next is financial distress. Financial distress is meant by the situations or circumstance that is occurred by company or individuals that have their financial condition in which they are struggle to pay their bills and their financial obligations. This means that the company is considered as having a financial distress when they cannot pay their debt or any other bills by their due date. If the company have a financial distress that persists for a lengthy period, that may result in bankruptcy of that company. When a situation of financial distress arises, it must be addressed as soon as possible to prevent the situation from worsening. One of the signs that a company may have a financial distress is when they have a cash flow problem. This happens when they have a continuous spending of cash more than what they earn. The common factors that this thing happen is because of poor spending decisions and outstanding accounts receivable. Next signs are the declining in sales of the company. This can happen due to the ineffective marketing of the product, or the company did not pay attention to their competitors, such as when their competitors might already launch a new product that have a new and great features that satisfy the consumer's needs. Okay, the company can overcome the financial distress by being more cautious when making purchasing decisions. Perhaps they have spent a lot of their money to purchase unnecessary things for each department of that company. Therefore, they need to review on what purchase requests that each of the department make and only purchase the necessary things.
Assalamualaikum and hi. My name is Muhammad Ikmal bin Muhammad Talha. I want to discuss the integration of tax effects and financial cost distress. The concept of tax integration is to eliminate tax differences that have to be paid due to choices in the business or income earning structure. What they want to do is to integrate taxes across various structures. This is to ensure that the amount of tax payable at the end of the day is equal to or nearly equal to the amount to be paid if the structure did not exist. Among the examples of tax integration mechanisms is the dividend tax credit. Companies have to pay income tax on the income they earn. Financial distress, commonly used in corporate finance, that describes a situation where the financial condition of an individual or company causes them to struggle to pay their bills. For examples, loan payments caused by creditors. In addition, severe and prolonged financial distress can cause an individual or company to go bankrupt. Besides that, in the financial distress, bankruptcy risk versus bankruptcy cost. The possibility of bankruptcy adversely affects the value of the firm. However, it is not the risk of bankruptcy itself that devalues, instead it is the cost associated with bankruptcy. Therefore, the shareholders who bear this cost. In the integration of tax effects and financial distress costs, there is a trade-off between the tax advantage of debt and the cost of financial distress. It is difficult to express this with an accurate and strict formula. Therefore, there is an optimal amount of debt for any individual firm. This approach, called the static trade-off theory of capital structure, the effects of tax is a firm borrows because the variable interest tax shield. In the financial distress cause, a firm cannot borrow an infinite amount because of bankruptcy risk. Interest from debt outweighs costs at a relatively low level of debt. Moreover, at relative high level of debt, the cost of debt outweighs the interest. Thus, it suggests that an optimal capital structure exists somewhere between these extremes. Level firm value is VL equal to VU plus TCB minus PV. Consequently, firms need to borrow to the point where the tax benefit from an extra dollar in debt is exactly equal to the cost that come from an increased probability of financial distress. Thank you.
Assalamualaikum. My name is Zam Akmal bin Zam Akmal. Now we will be discussing about the agency cost of equity. Agency cost is the cost incurred by the company because of the problems associated with the different interests of the management and the shareholders. These conflicts arise because of the shareholders wants the managers to take decisions that will benefit them. The shareholders want the manager to run the company in a way that shareholders' value is maximized. Managers instead would prefer to run the company in a way that expand the company and increase their salaries, which may not necessarily increase share value. Agency cost of equity is costs that happen when there is a conflict between the shareholders and managers. This cost arises when management make decisions that are not in the best interest of the company and that the shareholders see as action that will not raise the value of the share values. For example, the manager may consider that a merger is the best step forward for the company, but the shareholders see that a merger would not help to develop the company, and the money spent on the merger may be better spent on dividends and other investments. The cost of avoiding the merger would be the agency cost of equity. The agency cost of equity also occurred due to the suboptimal decision by management and the cost incurred the management to prevent them from taking these decisions. When management differs from the interest of shareholders for any reason, the cost will be borne by the shareholders. Therefore, the cost of keeping a check on decision of management by the shareholders is known as the agency cost of equity. For a variety of reasons, the management would fail to operate in the best interest of shareholders, including personal agendas, company development that make it harder to provide communicating information to shareholders and weaken management incentives.
Backing other theory. The backing other theory states that a company should prefer to finance itself first internally through return earnings. If the source of financing is unavailable, a company should then finance itself through debt. Finally, and as a last resort, a company should finance itself through the issue of the new equity. The reputation is significant since it informs the public about the company performance. When the firm funds itself internally, it is a powerful corporation. If a corporation finances itself using debt, this is mean management feel confident in the company ability to make monthly obligation. When a corporation funds itself by issuing additional stock, it's usually a bad indicator, since the company believes its stock is evaluated and wants to earn money before the price drop. Signaling hypothesis. Managers know more about their firms than outside investors do, and they are reluctant to issue stock when they believe the price is too low. They try to time issue when shares are fairly priced or overpriced. This is conveys some signaling hypothesis or negative signal when the investor will understand this as bad news. That explains why stock price usually falls when a stock issue is announced. In contrast, an example of positive signal is when the company announced an increased regular dividend. The stock price typically will rise because the investor interpret as the sign of management confidence in the future earnings. This can happen only if manager know more in the first place.